Hey, good afternoon, folks. This is Sunday afternoon here, and I'm doing this video because there's a couple of subscribers trying to figure out what is a stock option. Okay, so what I'm going to do is this is just an entry level what a stock option is. We're going to discuss the history of stock options, and there's a document from Brian Burns, author of Trading Stock Options, and we're also going to cover the equity stock options basics. Okay, what everything means. Okay, and then and we're going to be working off of a Merrill Edge trading platform, and then we're going to review one of my positions on the tracker. So we're going to review a put option and a call option. And if you're new to our channel, please click the money icon to the left of any of my comments down below and to review any of my 80 plus past videos to give you more knowledge about our channel. And click the like button. I need everybody to click the like button and subscribe so you can get these videos in front of other people, and then you can get this content whenever it comes out. Now, this is beginning entry level, so just bear with me. We're going to go through this, okay? And so let's get started. Now, let's get into the history of stock options. Now, the options have come a long ways since Aristotle wrote about their use in the making of olive oil. Here's what new investors need to know about their history. Perhaps you are familiar with stock options or have been trading them. But didn't you ever wonder how options came in the first place? Do you know why they were invented and who used them? You may or may not know the option is a derivative. Okay, a derivative is anything that derives its value from an underlying asset. In the case of stock options, the stock is the underlying asset. The underlying asset is the stock. Without the stock, you can't do a stock option. Okay, options come in two flavors. They come in calls and puts. Calls gives you, the option buyer, the right, but not the obligation to purchase the underlying stock at a specified price, known as the strike price. And we're going to get into strike prices and everything else later. And I'm going to show you an example. Now, calls, remember, calls, when you buy a call, it gives you the option as the buyer, the right, but not the obligation to purchase the underlying stock at that strike price, okay, known as a strike price, specific price, strike price. Now, the same happens here for a put. Puts give the option buyer the right, but not the obligation to sell. In this case, it's to sell. Remember, the call was to buy. To purchase is to buy. Okay, to purchase is to buy the underlying stock. Okay, whereas a put, when you buy a put, you have the right to sell the underlying stock at a specific price. Both types of options contracts are subject to expiration and can expire worthless. The option contract's length of time, also known as expiration date, is agreed upon at the time of the purchase. Calls can only be exercised when the underlying stock is above the agreed upon strike price. Puts can only be exercised when the underlying stock is below the agreed upon strike price. And then during the life of the contract, options can be bought and sold through most online brokers. Remember, the life of the contract. Remember, it's a contract that expires. It's no doubt that options are growing in popularity. Most brokers now offer free option trading tools, and the commission rates to trading options have continually been on the decline. But when did option trading first originate? Most option historians point to two main examples of how options were first used. Thiels, the Milesons, and the turnip bulb bubble of 1637. Wow, that was a long time ago, 1637. Here's that word again, Aristotle. mentions tales in the politics. The consensus is that politics, which was written around 350 BC, before Christ times, is mentioned briefly in one of the sections of with the Aristotle describes how useful it is to achieve a monopoly of any facet of business. Okay, then they go through this philosopher, and then they go through predictions, and then how olive presses would be selling for a higher rate, and how to capitalize on it. Now this document, the internet document, I'm going to put down in the remarks section. So if you scroll down below the video and you click down to see more, you'll see this document there, and you can read about all of this. This could take us a while to read. Then they talk about the turn-up bulbs of the 1630s, okay, and how the option and futures become popular derivatives during this time period for a couple of reasons. The delay for delivery and leverage. A lot of it's speculations on the leverage. And then they talk about this bank here, and when it collapsed from the 1762 and then times 1995 was the oldest bank in England. And then here's one example. A trader could sell an option to open a position on one exchange and then buy the same type of option on another exchange with the goal of profiting from the price discrepancies between the two exchanges. This would be a low risk, low reward type of strategy, but if employed numerous times and managed effectively, it could be quite profitable. And then they talk about the changes, and then they talk about back here at the earthquake of Japan in 1914. While options have been trading throughout U.S. history, stock options trading at today's volumes and by the individual investor is a relatively recent phenomenon. Most of the option trading prior to 1973 had been done by farmers and businesses seeking to hedge their agriculture exposure. Options were used in order to lock in prices for both selling and purchasing crops. What we call that right now is called the futures. If you look at the futures, they trade commodities, as in oranges, all sorts of stuff. That's what today is showing. Okay, one of the most important changes to the stock option market in the United States is known as standardization. Before 1973, option buyers made individual contract agreements with option sellers. This made the option market very liquid, as the terms for each contract might be different. Once stock options were standardized, it meant that one contract equals 100 shares of stock. Although there are exceptions. Okay, now there is exceptions. They have these things called mini options, and I believe each contract is 10 shares. But then again, it's because the high price in the actual price of the stocks was just so high. They're like $1,000 a share to $3,000 a share for one share of stock. So you would have to look at that. I don't play with minis. I don't do any of that. I deal with contracts only dealing with one contract equals 100 shares of stock. In addition to the size of the contract, the expiration date, and strike price were also standardized. In 1973, the Chicago Board of Options Exchange, which called the CBOE, you might hear about it from time to time, became the first U.S. exchange to trade listed stock options. They're out of Chicago, folks. They're not out of New York. The CBOE offered call option trading on 16 different stocks. That was back in 1973. Before this, there was no exchange set up to match buyers and sellers of option contracts. Then in 1975, that's where the SEC got involved, which is Securities and Exchange Commission. You guys might have heard about them, called the SEC. They go after companies and stuff like that. Enabled the Options Clearinghouse, which is the OCC, to serve as a central clearinghouse for all exchange-traded options. This was a critical improvement to the options market as it helped ensure the validity and the liquidity of the markets. Okay, basically the checks and balances. The OCC acts as a guarantor, and its job is to make sure that all obligations of the option contract bought and sold are fulfilled. The OCC operates under the jurisdiction of the SEC. In 1977, the SEC allowed the trading of put options. In that same year, the SEC also placed a moratorium on additional listings of options to evaluate the growth and the risk of the option industry. This moratorium was lifted in 1980, which paved the way for option trading on more stocks. In 1982, the OCC had an average daily options contract volume of 500,000 contracts per day. In 2008, the OCC had a record of over 30 million option contracts traded in a single day. Wow. So they went from 500,000 in one day to over 30 million. Wow. The birth of the internet and the rise of the online brokers has given the individual investor the tools to trade stock options like never before. Most online brokers offer free trading tools that in the past would have cost thousands of dollars for you to do. In addition, the commissions to trade options have never been lower. These factors have led to a recent growth in the popularity of trading stock options, which by all accounts appear to be here to stay. So now you understand the history. This is a brief history. Like I stated, I'm going to put it down below so you guys can review it. All right, let's now move on to Merrill Edge. This is Merrill Edge account here. You can look into options, do your research, go through options, basics. They'll go through what is an option, what types of options are there. We're going to be covering equity option basics. Now the next one you would want to get into is equity index options. That's with index funds, not with individual stocks, but only with index funds that have a basket of stocks. And then what you have is leaps. Leaps are for long-term investors for a year out or more. This is all good to look at. And then what is the Greeks? Later on, we will cover the Greeks because there's been questions on the Greeks. And it affects options, just so you know. How slow an option depreciates in value. Okay, it's all based off of the Greeks. But that'll be a different video. This is our second part that we're going to cover. Equity option basics. All right, options are a financial instruments that provide flexibility in almost any investment situation. Options give you options. Options give you options. You know, look at that. Okay, by providing the ability to tailor your position to your situation. Sometimes I say that too. Options give you options. Okay, and people will be saying, what are you trying to say? Are you talking about the option or are you trying to talk about options of the option? Okay, it can be confusing, guys. You can hedge stock holdings from a decline in a market price. Hey, that's what we should have been doing this last week, right? On covered calls that I've been showing you guys. You can increase income against current stock holdings. Increase income. Covered calls, think about it, giving yourself weekly dividends or monthly dividends. You can prepare to buy stock at a lower price. That's when we sell a put option at a drastically lower strike price or a lower price than the actual market price. So you can position yourself for a big market move, even when you don't know which way prices will move. Again, covered calls, you protecting your underlying asset from depreciating for a longer period of time. You can benefit from a stock price's rise or fall without incurring the cost of buying the stock outright. Options can be very tricky, and I'm just going to keep keep it down to covered calls and selling put options for premium, and we'll get down to them. Describing equity options. Here we go again. An equity option is a contract that conveys to its holder the right, but not the obligation, to buy. That's when you buy a call or sell in the case of a put. Okay, shares of the underlying security at a specific price, the strike price, on or before a given date, which is called the expiration date. After the given date, the option ceases to exist. It dies. It just goes away. The seller of an option is, in turn, obligated to sell. So the seller has to sell. He's obligated in the case of a call, or buy in the case of a put. The shares to or from the buyer at the option at the specified price, the strike price, upon the buyer's request. So you can be exercised early. It's called exercise. Equity option contracts usually represent 100 shares of the underlying stock. Remember, we discussed that in the previous. Strike price or exercise price are the stated price per share at which the underlying security may be purchased, or in case of a call, or sold in the case of a put. Due to the do not confuse the strike price or fixed speculation of an option contract with the premium. Premium is the price at which the contract trades. We're going to go through the premiums here in a little bit. Equity option trade prices are listed in increments of 0.5, like 50 cents, $1, $2, $5, 5 or 10 points, depending on their price levels. Adjustments to the equity option contract sizes delivered and are counted for splits and mergers. Generally, at any given time, you can purchase a particular equity option with one or at least 4 expiration dates. Equity option holders do not enjoy the right to shareholders. Equity option holders do not enjoy the rights of a shareholders, i.e., voting rights, cash, or special dividends. Just like Rocket's coming up, we got a special dividend. If you got an option, but you don't own the stock, guess what? You're not getting the dividend. A call holder must exercise the option and take ownership of underlying shares to be eligible for these rights. So it means you have to exercise it. So if you bought a call, you would have to exercise that call from that person that sold that option in order to get the dividends. We won't have to worry about that because we don't buy calls. We only sell calls. So we're the ones that people might be exercising the shares from. Buyers and sellers set option prices in the exchange markets. All trading is conducted in a competitive manner of an auction market. So the prices go up and down. You'll see that when we're trading, that the prices go up and down when we're trying to get a certain price or we're trying to get a certain type of premium. And so you might have seen that already in some of my videos. So I'm trying to get an extra maybe $30, or I'm trying to get an extra $50 profit or $100 profit or something, or $300 versus I want to get $300 versus $200, for profits, for premium, which is profits in my pocket, if it doesn't get called away. Okay, calls and puts. The 2 types of equity options are calls and puts. A call option gives you the holder the right to buy 100 shares of the underlying security at the strike price. Whereas the opposite of a call option is a put option, which gives the holder the right to sell 100 shares. Remember, if you buy a call option, you got the right to buy the shares at the strike price. And if you buy puts, you have the right to sell. We're doing the opposite. We're going to be this on the selling side. Here's the holder, is the buyer. We're the writers on the selling side, just so you know. We play in this area. We do not play in here. Okay, people that buy calls have the right to buy. people that sell calls, we have the obligation to sell, but we pick up a premium. It's called an option premium. It's all about the premium, just like here when we sell a put option. We have the obligation to buy. The seller has the obligation to buy. What is option premiums here? An option price is called the premium. Don't get it confused with a strike price. It's the premium. It's what the option is going for that's on that strike price. The option holder's potential loss is limited to the initial premium paid for the contract. Ultimately, the writer has the unlimited potential loss. The reason that is a stock can go to zero. Any stock. Tesla stock can go to zero. Any stock in the stock market can go to zero. That's why we have unlimited potential loss. We get a premium because we're holding the stock. And we're holding the stock only because we like the stock. Remember, we don't get into a stock unless we like it. If you don't like the stock, do not buy the stock and then do a cover call against it. There's no reason for it because you don't want to have it. Okay, because I'm telling you, because there's going to be times that you're going to be holding a stock for a month or two before you can get rid of it when you're selling covered calls. Or if you did a cash secured put and end up with the stock, you could end up with that stock for a month or two, or maybe up to 6 months, and you just keep selling covered calls against it. But just keep that in mind. Remember, any stock that you purchased, because remember, we're on this side of the house, we're the writers. You gotta like the stock. That's number one. Doesn't matter what the price is right now. You might be keeping that stock for 20 years from now. I don't know what your objective is with that stock. It's your objective. It's not my objective. It's your objective. So remember, what stock you pick is a stock you might end up keeping for a while. But it's no problem because whether it goes up and down, that's on you. Okay? Because you want to keep that stock. Or you want that stock. That's why you got into it. And investors can use put and call options to take positions in a market using limited capital. The initial investment is limited to the price of the premium. All right, let's a call option on an individual stock issue may be sold to provide a limited degree of downside protection in exchange for limited upside potential. When you sell a call option, you have a limit to your profits. It's because you're limited to the strike price itself. And I'll show it to you that in a minute here, once we go to my diagram. Okay, now they talk about expiration Friday. Most options that expire in a given month usually expire on the third Friday of the month. So therefore, if there's only one option in a month, it's called a monthly option. It's normally done on the third Friday of the month. Therefore, the third Friday is the last trading day of all expiring equity options. This day is called the expiration Friday. If the third Friday of the month is an exchange holiday, the last trading day is the Thursday immediately preceding this exchange holiday. Okay, after the expiration, the option's expiration date, the contract ceases to exist. Again, it's a contract. It expires, has an expiration date. At that point, the owner of the option who does not exercise the contract has no right, and the seller has no obligation to previously convey any of the contract. That means if it's out of the money, you don't have to lose this contract. All right, now what I'm going to do is, this is all in the Merrill Edge, and I'm going to just copy and paste this down into the remarks section. You can read all this. Okay, you guys got a lot of reading to do here if you're just starting off with options. You need to investigate, educate yourself, investigate, educate, and then watch me trade. You're going to see how different trades are going to go out of the money, go into the money. Sometimes we're going to do okay in the week. Sometimes we have to wait to a couple more weeks to get rid of a certain stock. You know, sometimes it works that way. Markets go up, markets go down. Now let's go to my spreadsheet here. Now here is my tracker. You guys seen my tracker if you watch my other videos. All right, I locked this pain right here, and I put two of these closed positions already here. One's a put option. This is a put option because it has a P in front of it. Where it says option, it has a P here, it says put. This is going to be a call option because it has a C, 22. This is how we read this. On this date here, we didn't purchase this stock because remember, it's a put option. We sold to open a put option. Now this, when you see this, even though you have a symbol here of RKT, you got to have a stock. Remember, it's a derivative. So we have to have a stock that it's against. So what we did up here for put option, we went against IBM. I picked a lower price. I picked the strike price of 119. What happened was it was over 120. So therefore it did not break 119 or below. So therefore I was not exercised. I did not get put to stock. All right, when you sell to open a put option, a cash secured put, that's what Merrill Edge does. A lot of other brokerages, you got to have cash on the line. Okay, set aside for this put option just in case you get put to stock. All right, if it doesn't drop below the amount, the strike price of 119, you don't get put to stock. So that means the premium that I received of $180 on 128, remember the expiration date is 1 day later, is January 29th, because remember, it's only been 1 day and it expires. We were given the $180 and I turned around and I decided to cover the position by buying to close the position. Remember, we sell to open the position on 129 and I sold to close the same position actually the next day on 129, and I gave back $40. It cost me $40. That's called brokerage fee and what premium was left, and I got to keep $140, a profit. There we go, profit 140, profit 140. So that was good. I made $140. That's my money. They can't take it away. This position's finished. On the other hand, here's a call option. We bought the stock. Doesn't matter when we bought the stock. In this case, we bought the stock on 2/26/21. 5 days later, at the same time we bought the stock, we did a covered call. We sold to open with the strike price of 22. And what happened was it went over 22. It actually went a lot higher, almost $30 a share, just so you know, rocket. And I got early assigned on the 3rd of March. Basically, they took away my stock and they gave me only $22 a share back for my stock. And that's where my covered price is right here. Because 500 shares times 22 equals $11,000. So then I made only $20 off of the difference between the cost of the shares to what they paid me for and based off the strike price. This is based off strike price. Okay? And then the premium, I got to keep the whole premium. So together, when you add it together, down here below, it's $492, which is $492. So I made, in 5 days, a profit of $492. I got to keep in my pocket. But I no longer had those shares anymore of Rocket. They're gone. And that other person, whoever has the shares, probably turned around and sold them immediately because now they're worth $30 a share at the time. And I gave him a discount. I gave him to him at $22 plus his premium. So he done pretty good. So with $23, he made, off of this trade, he made $7 times 500. Shoot, he made $3,500. He made $3,500 because he bought these calls that I sold him. We didn't know that the stock was going to take off like that, by the way, just so you know. But I got my profit and I was done. I hope you guys understand this. Because I do this all the time and I try to be meticulous about it. And what I'm going to do is I'm going to put a couple videos at the end for you guys to review. And they're more about covered calls and deeper into covered calls. Matter of fact, if you need these spreadsheets like this, I'll also put a video with the spreadsheets. Okay, let me read this. You guys can read this disclosure here. before investing, just be careful. Do your own education. Remember, my stock picks here, I don't want you to emulate them. If you have a certain stock, if you like the certain stocks that I'm into, that's up to you. Okay? And just be careful out there. Try to paper trade before you do regular trades, especially if you're a beginner. Just watch me make money, watch me lose money. There's times that we lose, but we'll win later. The markets go up, remember, and the markets go down. So please share our videos with others. If you like these type of videos, please put down in the comments below if you need to learn something special or something, or if you like how I did this video. And then please click the like button and subscribe so that you can get future content. Okay, I appreciate everybody watching. I know this is a longer video than normal, but remember, it's an educational video and subscribers wanted me to make it. Thank you, and you guys take care of yourselves. This is Sonny. I'm out.